Discounted cash flow models, what they are, what exactly do they do. In this video, we're going to be talking about my own version of a discounted cash flow model, walk through it. The gist of it is you're taking the future cash flows and discounting it back to a present value, taking that sum and basically figuring out what the value per share of that company is to determine whether or not the current price of the shares are overvalued, undervalued, fairly valued, all that good stuff. So we're going to go through the whole thing and you'll see that a lot of discounted cash flow models are super dependent on the assumptions. Here's a discounted cash flow model that I created for my patrons. High level, this is taking all of the cash flows in the future, discounting it back to a present value, and then adding kind of what the company already has on its books in terms of present value. So anything with a highlighted cell in this model is an assumption. Everything else is just a calculation. So according to all the assumptions that I had put in for flowers.com at this point, we come up with $33 per share as the fair value. We'll talk about, there's three major parts of this model that comes up with that $33 per share. I also want to drive home the point that the assumptions built into a discounted cash flow model is super important, because if I say the growth rate of flowers.com is 100% per year, you're going to get a ridiculous number that shoots out for the share value. The stock could be trading at 25 and you put in crazy assumptions, all of a sudden you're projecting that the company is worth $200 per share. That's why you have to be a little conservative. You have to have reasons behind your assumptions, and that is the most important part of the entire model, because realistically it's just Excel, right? It's not doing something crazy. It's taking your assumptions and backing into a value per share. So your assumptions are the most important thing in the model. The first part of the equation is how much cash versus debt do they currently have on the books? Because if you take all the cash minus all the debt, that's realistically what's on the books, and that's the present value of the cash that the company owns. So even if they didn't have any business and all they had was cash on the books, that would be the present value of the company, right? So $240 million worth of cash and $170 million worth of debt. The difference, that's kind of what you're looking at as intrinsic value as of today. The second part of the equation is taking the future cash flows and discounting it back to today's value. So if we look at this model, it's looking at the next 5 years and taking assumptions to figure out how much cash flow is going to be generated in each year. So for the first year, $92 million is expected to be generated. Now, this $92 million isn't worth the same as $92 million today, because $1 today is worth more than $1 tomorrow. And the reason for that is if I take $1 today, I can invest it and turn it into $1.08 from a year from now. These future dollars aren't worth as much. So what we have to do is take the sum of these and discount it back to a current day value to figure out how much are these future cash flows actually worth in today's dollars. So that's the second part of the equation. The last part of the equation is known as terminal value. We only projected 5 years worth of assumptions. So we only have 5 years of specific cash flows. For 2026 and beyond, we're trying to figure out how much value is the company going to generate in terms of cash from that point on. So we use an assumption, something like perpetual growth rate or EV to EBITDA multiples, and we come up with a amount that we think the company is going to generate in cash flows from 2026 and beyond. And we basically discount it back to that 2026 year. And then we take that and discount it back to today's value. So we discount all of the future cash flows back to a certain point, and then take that lump sum and then discount it back to today's value. And so you have kind of the three parts, right? You have the starting cash and kind of what the company has on its books, plus the next 5 years worth of cash flows. And then lastly, you have the terminal value from all the cash flows from that point on. So you're discounting all of that back to the today's value or equity value. In this case, we're saying $2.15 billion in equity value is the expected value of this company, or the fair value. And so that comes out to $33.24. Cash flow this, cash flow that. You're probably sick of hearing me say cash flow and discounting and all that stuff. How do you actually use the model to come up with those cash flows? That way you can figure out part 1, part 2, and part 3 of kind of the calculation for the intrinsic value. So this model starts with all of the main assumptions up here. Tax rate. How much are you actually going to pay in taxes based on the earnings that the company has? Weighted average cost of capital, what is the discount rate you're going to use for future cash flows? So this $111 million in 2025, that's the rate you're going to use to discount back to a present value. Perpetual growth rate as well as EV/EBITDA multiple. This is going to be used to come up with the terminal value. Current stock price, you're just going to get that from Yahoo Finance or whatever the current stock price is. Transaction date, this is the snapshot that you're going to be taking for things like balance sheet as well as implied shares outstanding. So all of this information can be, received from something like Yahoo Finance, but implied shares outstanding, 64 million shares. You have the debt, as well as the cash and the amount of capex that's spent on a yearly basis. This is the fiscal year end. And what terminal value method do you want to use? I picked the average between perpetual growth and then the EV/EBITDA multiple. Those are your high level assumptions. Now, this transaction date, the 12/31/2020, this is your starting point for all of the assumptions in column E. Because if you, let's say, had another quarter worth of data, and we look at the cash flows for 2021, you can see that the multiplier is 0.75 because in this quarter, we're already in 2021. But if I'm looking at a full year in December 2020, right, then we have a whole year between this date and this date. The assumption is this is the starting point for all of your different criteria over to the left, and then in 2021 through 2025 is when you're estimating kind of a projection of each of those criteria. To get to free cash flow, you start with EBIT, which is earnings before interest and taxes. Then you subtract out the taxes that you're paying because that's a cash outflow. You add back in depreciation and amortization because that's a non-cash expense. And then you subtract out CapEx, which is a cash outflow. And then lastly, you subtract out any increase in net working capital, which is current assets minus current liabilities. Starting point is column E, and then columns F through J are your projection years. So each of those projection years, you're coming up with the cash flow that you think the business is going to generate. Since EBIT is the starting point for free cash flow, how does my model calculate the EBIT? It starts with revenue. So I used, a starting point, how much I think the revenue is going to grow or decrease over the years, use a percentage to increase or decrease that revenue. Then when it comes to actually how much money is made from that revenue, I look at kind of the historical operating margin and whether or not I think it's going to improve or decrease, and that's how much money they're making off of the revenue that the company's generating. Then any other income, I'll look at kind of the past to see, should I put anything here or just kind of keep it the same as what it was in the past. So this one, once again, heavily influenced by your assumptions. And each year you'll see the operating income plus the other income is your EBIT. The second piece is how much in taxes are you gonna be paying on that income. So you have to come up with the pre-tax income. What I have is the EBIT minus the interest expense is the pre-tax income. In order to come up with the interest expense, I also look at previous years to see how much debt was actually on the balance sheet and how much interest expense did the company pay, come up with kind of an average interest rate, and then do I use that same amount for each year or do I adjust it? And then also you can project, are they going to pay down debt? Are they going to increase debt? Once again, that's kind of your assumptions around the company and how much debt they're going to take out or pay down. And then you come up with how much interest they're going to pay each year. So you take your amount of income that you made from the business itself minus the interest that you're paying, and you're going to come down to the pre-tax income, take a tax percentage to multiply that by, and you'll get the net income, or what's left after the taxes are paid. Depreciation and amortization, I usually use a percentage of the revenue to project out what it will be each year. So I looked at the starting point, it was around 2% of the revenue is depreciation, and used that kind of as the assumption. So that will be added back to the free cash flow because that is a non-cash expense. When you have depreciation on an asset, you're not actually paying cash out the door. It's just an accounting thing where basically you have the asset value and over time you're depreciating it and taking an expense hit over time. CapEx is similar to depreciation and amortization, is that I used a percentage of revenue. So around 2.14% of revenue is CapEx spend. And this is the amount of money that's used to sustain the business. So invest in capital assets. The assumption is 2% of the revenue will go back back into just operating the business by buying additional capital assets. And lastly, you have the working capital, which is made up of things like accounts receivable, accounts payable, your inventory, and the working capital is just the current assets minus the liabilities. If your assets are increasing, cash flow is probably going out the door. Whereas if your liabilities are increasing faster than your current assets, you're probably receiving cash from that situation. So that's kind of how this is looking at it. I use the working capital assumption as a percentage of revenue, and each year, the year-over-year change in net working capital would be a cash outflow. So you can see the working capital is increasing, so that would decrease my free cash flow. And for a year that it's decreasing, well, then you'll actually increase your free cash flow. You may have noticed that my discount cash flow model is pretty high level, where you can go even more granular. So you could go to the financial statement point of view, where you project out the financial statements for 5 years, and that way you're projecting down to the level of, okay, inventory is going to be increasing on this specific year, capital assets on this year, debt's going to be paid down on this year, but I don't have that granularity. So for me, I use a high level assumption like a percentage of revenue and run with that. So these 5 years are F through J. This is your free cash flow that you're projecting. And then in order to discount that back, we have this formula equals X NPV. So it's calculating the net present value of cash flows over a certain period of time. And in this situation, it's looking at the terminal value as well. For terminal value, I have the perpetual growth rate projection, which takes that last year free cash flow and factors in a 6% growth rate at that discount rate from there on out. That calculates $2.6 billion. And then the EV/EBITDA multiple is just taking the EBITDA multiplied by a certain multiple to get to an enterprise value. So it's saying the exit terminal value for a company that's having an EBITDA of the 39 million plus the 145 million would be $2.9 billion. And for terminal value, I just take the average between the two. So now we have all the parts to the model. We have the current state of the cash and debt. You have the next 5 years projected as well as the terminal value. So this is discounting the cash flows for the 5 years plus the terminal value. This is taking the cash on the balance sheet as of the transaction date as well as the debt. And you have a intrinsic value of $2.1 billion for the company as of now. This is the fair value or the intrinsic value in today's dollars, which you just take that and divide by the implied shares outstanding, so the amount of shares that are trading for the company, and that's how you come up with $33.24 per share. All you have to do from there is take the difference between the current value and that projected fair value and take the difference divided by what you'd be able to buy it by today. And this is showing that if you were able to buy flowers.com at $24.34, there's upside potential of 36% based on all the assumptions that we put into this model. Now, I know this may have not been the most exciting video with a lot of pictures and moving parts, but this is what a discount cash flow model is. It's taking the assumptions for the next 5 years or the next 10 years, figuring out what those future cash flows are, and discounting it back to today's value using a discount rate. That's a discount cash flow model summed up. Walking through the model, there's 3 parts, like I talked about. There's a starting point, there is the next 5 years, and then there's the terminal value. At the base of it, it's really simple, but what you have to watch out for, as I kind of talked about earlier in the video, is using these assumptions to really jack up the price, because garbage in, garbage out for your fair value. So if you use conservative estimates and the projected fair value per share is still relatively higher than the current price, then you may be onto something and you can leave room to be wrong about your assumptions. So kind of play with it in terms of like scenario analysis. If the revenue goes down more than you thought, is it still a good buy? If you play with the discount rate, if you increase it, the value of the share will go down, all that stuff. So you want to play around to see in different situations if something plays out or not. Is the stock at its current value still a good buy? Hope you guys learned something in today's video, and if you did like the video, make sure to like it, as well as consider subscribing to Main Street Wolf, where we talk about money, stocks, investing, crypto, all that good stuff. Thanks guys for watching, and have a great day.